Appreciate everybody joining us here today. Just make sure everybody can hear me all right. Dave, can I get a thumbs up if you can hear me all right? All right, great. Hey, I'm Chris Maxwell. I'm a partner in the corporate technology group at Morse Manning, located here in Atlanta. I lead our corporate emerging companies and growth equity practice and our Florida practice. So unfortunately, I haven't been able to get down to Florida as much as I'd like to recently, but very excited about what's going on in the market down there, and very excited to bring Technology Executives Roundtable and TER Florida to the state of Florida. We're very excited about that, and I'll talk a little bit more about Technology Executives Roundtable and TER here in a moment. We got an excellent panel here for you today talking about venture capital and growth equity investing and what those investors are looking for in Florida companies. So very excited to have you all here today, and excited to get this event kicked off. So without further ado, I'd like to jump in by thanking our sponsors and our primary sponsor today, which is the Florida Venture Forum Florida Venture Conference. The Florida Venture Forum Venture Conference is coming up next week, March 3rd and 4th. I believe that's Wednesday and Thursday. It's one of the best venture conferences I've ever been to, one of the best in the Southeast, definitely the best in the state of Florida. Expecting over a couple hundred investors, over 40 great companies will be presenting, great panels, great speakers. If you haven't signed up for it, strongly recommend you do so. We think it's going to be a great event. So Florida Venture Forum next week, so check it out. Next, I'd like to thank our sponsors who helped put this together and bring our panel together today. 360 Advisory Group, Cherry Beckert, Colliers International, Alliance Bernstein, Bridge Bank, Dual Boot Partners, Orchid Black, Finance Cake, Trinet, and CFO Alliance. Without our sponsors, we couldn't be here to do this today. So we really appreciate you guys being a part of the team and helping pull this off. Really appreciate it. Next, I'd like to tell you guys a little bit about Technology Executives Roundtable before we jump into the panel. Technology Executives Roundtable has been around for over 20 years in Atlanta. It's an organization focused on technology companies, obviously, and the C-level executives that run them. So the idea is we get together on a pretty regular basis. Here in Atlanta, it's on a monthly basis, and some of the other markets we've expanded into, Charlotte, Charleston, and others, it's a quarterly basis. So just depending on the market, depends on how frequently we meet. But the idea is for C-level executives to have a venue to get together and talk about the issues, facing technology companies, whether that's capital raising, like we'll be discussing today, whether it's M&A, whether it's changes in accounting and legal requirements that affect technology companies. So the idea is just to have a place to get together. And unfortunately, right now it's being virtual throughout the markets, but we're hoping by the end of this year or maybe early next to be back in person. And that means in Florida as well. So we're hoping by late this year or early next year to be planning events most likely in Tampa, Orlando, and Miami. We're not really sure how that's going to look yet, but as we get more information, as we, the organization progresses, we'll certainly keep everybody who's here today updated on how that's going. So we're certainly excited about it. But for the time being, would love to get the panel kicked off for today. We got a great panel for you. Unfortunately, one of our panelists had a COVID-related incident that had to abandon us today, and so we're sorry to miss him. Drew Weatherford's not going to be able to make it, but certainly, hopefully, you guys can see him speak at Florida Venture Forum Conference next week. But without further ado, I'm hoping my last panelist made it in and we got the technical difficulties resolved. But why not start with Dave Sack with Radiant Capital out of New York City. And Dave, why don't you go ahead and introduce yourself, and then we'll move on to the other panelists.
Yeah, absolutely. Well, great to meet everyone. I should say I live and work in New York City for Radiant, but I am born and raised in Jacksonville, Florida. So I'm not, as unfamiliar with the state as some of the other folks that come down, once a year or longer term, it seems, during COVID. But I work with Radiant Capital. We're an early growth fund. And we take a unique, supportive, functional approach to investing. We're a $315 million fund, writing typically minority checks in the $10 to $40 million range.
Thanks, Dave. Appreciate you joining us. Ryan Whittemore from Florida Funders.
Yeah, thanks for having me. I am excited to be here. And so Florida Funders is a hybrid venture fund, and we have 1,600 members in our accredited angel investor network. So they are able to invest through an SPV alongside of the fund. We just fully deployed our first fund. We're excited about that, 35 companies. And so we're raising our second fund now, targeting 75 million. We've got the first about 20 million closed, and we've closed 7 deals already in that. So we're moving along quickly, and we're focused in the Southeast in Florida primarily. And so we're about 90% of our deals fall, and we focus on seed to Series A deals, typically with about $500,000 check size from our fund, and typically an average of about $500,000 from our angel network.
Great. Now the moment of truth. Jennifer, are you there? Is Jennifer able to make it in? Still having issues? All right. So Amelia and my team here are working to get Jennifer Dunham with Arsenal Partners on the line as well. We'd love to have her view. Arsenal's located out of Orlando, similar to Dave, venture capital, growth equity investor. Love to get her insight. So hopefully we'll be able to get her onto the panel here momentarily. Unfortunately, as I mentioned, Drew Weatherford with Weatherford Capital, a larger later stage investor out of Florida, was unable to make it due to a family emergency. So we'll miss him today. And hopefully if you get a chance to make it to Florida Venture Forum Venture Conference next week, you'll get to see Drew talk and tell us, you get to see and learn more about Weatherford Capital at that point. So Dave and Ryan, it's down to you guys. You guys are going to have to carry a lot here. But I know you both, and I know you're both prolific investors, and we'll do a great job. So why don't we just start with, it's the beginning of a new year, right? It seems to feel like, we're reaching, maybe if not the end, at least, we're starting to see some changes, with COVID and the capital markets coming out of COVID. Tell us kind of what you're seeing out there in the market right now, and the state of Florida. I mean, are things busy? Have they changed? And I'll leave it open to that. And Dave, why don't you, as an outsider, tell us a little bit about how you see the Florida market?
Yeah. So I guess, what we love most about Florida, I think there's sort of two sides to it. One, there's more capital available in the country and in the world than really any other time in history. But I do think that Florida is still overlooked in a lot of ways. So part of it is capital availability, but more than that, we like Florida for the same reason that a founder would like Florida, which is that, if you're founding a company in San Francisco or New York, you're going to be competing for talent on the engineering side, on the sales side, customer success side, with the Facebook and Googles of the world. But in Florida, which has plenty of great talent, UCF is graduating 3,000 engineers every year. You don't have that same level of sort of compensation race and really lack of loyalty in terms of the people that are coming out of those top institutions. I would bet in a Series A company in Florida versus one in New York, you're going to have much better engineers for that exact reason, which is that you don't have to worry about a recruiter calling them and pulling them over to Google or Facebook at any given moment.
Hey, Ryan, you're boots on the ground there. And I mean, Florida Funders, for you guys that don't know, is one of the most prolific early stage investors in the state of Florida. So they're seeing a lot as well. So I'd love to hear your input.
Yeah, I agree with everything Dave said. And it's fun because we're seeing a lot of the outside firms starting to take interest here. And it's really more of a collaborative environment than it is a competitive environment, in my opinion. And so, in our view, there's kind of 3 pillars to a successful ecosystem. I mean, you got to have the tech, you have to have the talent, and then you have to have the capital. And if you have those 3 things, it starts to self-perpetuate. And I think that's kind of where Florida is right now. We've had the tech, the talent, and the capital, but now you're starting to see companies like I saw Jackie on here, another bunch of great companies that are starting to grow, starting to get recognition on more of a national scale. And as they exit, ConnectWise here in Tampa's become a big cyber hub. Well, that spawned 70 new millionaires that were part of that company. Many of those became angel investors. Many of those became advisors, mentors. that spawned a new cyber school at USF. And so now that's spinning out new tech talent in cyber, and it's attracted other companies here. And I think there's 4 companies now, to my knowledge, that are either unicorns or about to be announced to be unicorns here in the Tampa Bay area focused in cyber. And obviously you're hearing about Miami, but I think that could go for Tampa, Orlando, Jacksonville, really anywhere over the state right now. People have obviously, I think everyone's kind of gotten aware that you can work remotely now, and it's gotten more comfortable to do so. So now it's kind of like pick where's the best place you want to live. And there's a lot of attractiveness to being here if you can have all those other successful things. And to Dave's point, the talent is vastly underrated here, and it's growing every single day because there's more and more people moving here willing to join startups and kind of reevaluated their life and want to work for some of these companies now while they're able to.
And so why don't we talk about that a little bit more, Ryan? Have you seen a tangible difference since COVID began of, just talent, influx of talent into your markets, into the companies that you're working with?
Yeah, absolutely. And still I'm seeing, I'd say it's twofold. Some of our companies, it's given them a greater ability to work remote. And so, it really doesn't matter where some of your team is. I'm still seeing a lot of the companies struggle to hire enterprise sales level executives. But in terms of engineers and developers, it seems to be that most of our companies are able to find top talent for that. And so I feel very comfortable with that. Whenever I get asked, that's probably the first question when we talk to big venture groups out of Silicon Valley or something. Well, is there talent there? I mean, our answer is a resounding yes.
That's great. And David, when you look at Florida, obviously you're looking at, you're in New York, you're looking at companies all over the country. Is that what you're seeing that's kind of separated? You do the Southeast, you look at Atlanta, you look at, you guys do stuff in the Midwest. You're obviously trying to stay outside of some of the larger cities with higher valuations. When you come to Florida and look at it, it seems to me that you guys are seeing the same talent and benefits down there that Ryan's seeing.
Absolutely. In fact, we're seeing increasingly when we're talking to companies that are based in New York or Chicago, they'll say, "Oh, we just opened an office in Tampa, or we just opened an office in Atlanta for developer talent or for customer success talent," because it doesn't make any sense to hire those people in San Francisco and New York. And I think that's sort of just a matter of time before you start to see the CEOs do the same thing or move to where the talent is. I've also seen on the CEO side, talking to companies in, where I thought the CEO was based in North Carolina or Dallas, and only to hear when I tell him I'm born and raised in Jacksonville, he says, "Oh yeah, I'm actually in Nocatee." Just having moved and not told anyone because you can work anywhere, particularly during COVID.
That's great. And I think Ryan, I think you mentioned there have been a lot of big exits and bigger exits coming. What are you guys seeing? And funds like Dave's are looking at Florida. Obviously, you guys are located there. Jennifer and Arsenal are located there. Weatherford Capital's located there. But are you seeing a lot of other funds kind of looking at Florida and noticing what's going on there and trying to come and deploy capital down there?
Yeah, absolutely. I think that's a trend that's not going to stop anytime soon. And for us, it's a positive for either co-investing or later stage. I think what has lacked is there's still not a lot of investors that can do those Series Bs, especially the Series C, Series D. So as these companies get bigger and bigger, that's where there's been a lack of capital, in my opinion. I think some of the earlier stage investors, it's starting to waken. I know founders always disagree with that, but the best founders, they find funding, and they can find it in Florida. But we're starting to see some of the really big firms come in, like the SoftBanks, and coming in. And Florida, from an outsider's perspective, is a huge geographical market. And the number one thing we hear the most is kind of like, where do we begin? Where do we tackle it? And I think that's part of why Miami has become such a hotspot, because it's a much smaller community inside the entire state. But I think as people get here, they're going to start to say, wow, there's a lot happening in Jacksonville and Nocatee and Gainesville and Tampa and kind of all over the state, Orlando, Naples. I mean, there's stuff happening everywhere. It's not just Miami. So soon it's going to be the state's known for that.
Oh, that's great. So what about, what we saw, and I'd just be interested in your and Dave's take on, y'all are investing at different kind of points in the capital stack, right? You're Florida Funders is a little bit earlier stage. Dave, you're a little bit more growth, Series A and later. But valuations, right? So we went through last year, a lot of unknowns came out, and everybody, at least for a short period of time, expected valuations to dip or become more favorable for investors. I think both of you will probably agree that that didn't really happen, or was very short-lived. What are you guys kind of seeing as far as valuation expectations of founders and kind of your expectations coming out of COVID?
I'm happy to jump in. So my perspective, I haven't talked to any investor that got a quote unquote good deal during the pandemic. I think there was a little bit of a flight to quality, meaning there are certain companies that were hampered by the pandemic, those requiring a complicated in-person sales cycle or selling into hospitality. Those typically would push off fundraising rather than take a raise in less advantageous time. And then, we saw others that were, had work from home tailwinds and were able to raise at much higher valuations, but usually that was backed up by metrics. We saw more companies that went from 1 million to 5 million plus in a year-over-year period in the last 12 months than I had in my entire career prior, because of the strength of some of the tailwinds. And so when you talk about, the multiples being really crazy, especially in the COVID year, I think part of it is that flight to quality. And part of it is that a lot of companies saw, 4 or 5 years of acceleration behind them happen this year as more people adopted cloud technology. So I would say in general, things were expensive before the pandemic. They continue to be expensive now. And from our perspective, we definitely believe we're in a bubble, but you can't sit on the sidelines and wait for a correction to come in the public markets that could come 2 years from now or tomorrow. You have to just back great companies and count on, multiple compression when eventually the exit comes around.
That's great. Right. How about you guys?
Yeah, I think we've kind of said that it's shifted back towards a neutral from kind of a founder-friendly valuation. So it's probably more fair at this point, as opposed to skewed to one or the other side. But the hard part is it's company specific, and the more cash they have, the more patience they have, and ability to show they can execute to get to profitability, I think has become more important than ever. They don't necessarily have to become profitable. They just have to show that they could be if something kind of pops up again. I think that kind of awareness of risk is more powerful than ever. And the companies that are the strongest, they're the ones that are kind of dictating more of the terms. There's still a lot of expectations for betting on the future, and companies come into hey, we want this multiple on our 2-year from now forecast. And it's like, well, it's not really how it works. You're betting on the upside if you are the investor. So there's still a lot of disconnect. And to Dave's point, I feel like it's kind of segmented from early stage. Some of our companies that have grown through the pandemic and are starting to reach those kind of later stage growth stage funds. I think some of them have experienced a little bit of compression that previously there probably would have been a much higher multiple, and now it's a little bit more compressed there. But if you can get to the IPO stage, it kind of accelerates to crazy valuations, bubble level. So it's kind of segment specific.
That's interesting. And I'm just going to preview this since we lost, looks like maybe 2 panelists. Dave and Brian are going to be doing a lot of talking. So if you guys out in the audience want to start thinking of some questions so we can start asking them maybe a little bit earlier and give them a little bit of a break from me just berating them, I'd appreciate it. So put your heads together out there. But anyway, what about hot verticals, right? I think a lot, obviously price, different companies and different verticals like I think Dave, you mentioned hospitality. Obviously, probably not a place where a lot of people are putting a lot of money now, but maybe something like logistics. Certainly some of the larger companies, and I know Ryan, you mentioned cybersecurity, bigger than ever. Any other input, maybe Dave, on kind of what you're looking at, some of the your thesis around some of the hot trends and verticals out there that you're tracking?
Yeah, absolutely. From our perspective, we are all B2B software, but within that, we have specific expertise around sort of commerce enablement, in which it would include logistics. One of my favorite companies in Florida is a business called OneRail out of Orlando, which enables last mile logistics for retailers. From an e-commerce perspective. So they had, obviously great tailwinds over the last 12 months. Other areas are healthcare and fintech. But for me, to Ryan's point, I get especially excited about the security space. And to the point around ConnectWise, we're seeing more and more interesting companies, not only within security, but specifically within the managed security services space within security and the software that those companies are using. LionGuard is one really interesting company in that space that I think, to our earlier point, they're based in Houston, but their sales and their entire sales office is based out of Tampa, that they opened there after raising a good chunk of money from Updata to capitalize on a lot of the ConnectWise talent and other sort of general talent coming out of USF. In that area. So you can't really overstate how important those types of exits are for an ecosystem. And so me personally, I get especially excited about the potential for Florida to become a cyber and an MSP technology hub in particular.
Great. And before I get Ryan's answer, I want to acknowledge Jennifer. I believe you are able to join us by phone. Are you there?
Can you hear me?
Yeah, there you are. Sorry for the technical difficulties, but thank you for joining us.
No, you're welcome. And I even put pants on today, so unfortunately you can't witness that.
Great. Well, why don't we pause, and Jennifer, why don't you introduce yourself and Arsenal, and then we'll get you into the conversation as well.
Sure, happy to do that. And again, apologies for the disruption. Jennifer Dunham, I'm a general partner with Arsenal Growth Equity, which is a private equity shop based here in Winter Park. We target high growth tech and tech-enabled businesses with recurring revenues from 4 to 20 million in 3 primary sectors, commerce and logistics, healthcare IT, and enterprise. Our typical investment ranges from $3 to $6 million. And Arsenal is also the investment advisor to the Florida Opportunity Fund, which focuses on seed, early and growth stage fund of funds and direct investment opportunities in and focused on the state of Florida. Investments there are targeted in industries of strategic importance to the state, which include healthcare, IT, and advanced manufacturing, among others. And the average check size for the FOF is 3 to 4 million.
Great. And why don't we just get you inserted right into the conversation? I think the question we're just discussing of any hot topics, trends, verticals. Obviously, it sounds like you have 3 kind of primary verticals you guys cover, but is there anything standing out to you guys right now that you guys are chasing on the investment side?
I think we share, I think it was Dave that was talking, obviously a significant interest in the security space. Not only is it relevant nationally, it's obviously a global problem. So we've looked at a number of deals in that space and are very keen on it. I'm sure everyone's commented on, the resurgence of remote cloud-based platforms with connectivity, for remote access for business, ed tech, health and fitness, and even social engagement. So we've looked at, a number of companies in those verticals as well.
That's great. Ryan, obviously, it sounds like security might be, interesting to you. That seems to be a theme, but anything else that you guys are chasing that's particularly interesting right now?
Yeah, I think, over the last year, it's kind of divided it up into different quadrants, really. So there's kind of like the neutral category that really wasn't affected at all by COVID. And that to me is like a cyber, a fintech. I mean, there's some cases you can be made there, but those have been attractive to us regardless. then you've got kind of these ones that benefited from this inflection point that we went through. And so there's been a lot of things that have become really interesting all of a sudden, and consumer tech and e-commerce, telehealth. We just did a really cool telehealth deal, Health Snap out of Miami, that we're super excited about. And then you got the logistics and ed tech, that, remote working technologies. Those are all super exciting right now because of what's happening. I don't see those trends changing anytime soon. And then you've got kind of the flip side of that is the negative ones. That I think stuff that's really capital intensive right now has become a lot harder to fund. And so you're looking at, like, both, everybody here said SaaS and enterprise level stuff that you're not having to continually fund and to where they never reach profitability. Those are really kind of negative. There's kind of an opportunistic category that I see, which is travel. In one of our travel companies, we invested in it right before the pandemic, but I've actually got a ton of confidence in what they're doing, and their global partners, Google and things like that. The word back from them is, we're ramping up during this time to get ready for an explosion in travel. So, I don't want to be late to that space. When you get the all clear, you probably missed the opportunity there, at least at the reasonable valuations. And the last thing I think a lot of people are really is underestimated right now is companies benefiting from a change in the regulatory environment. And post-COVID, regardless of political affiliations, there's this exodus out of states, and I think you're going to see a massive push for taxes and shifting around of people. And so, like, we did a company called Simple Bet, which is allowing companies or individuals to bet on games interactively during a sporting event. The reason why I say that's important or exciting to us is because all of a sudden for years and years and years, sports wagering has been outlawed across most states. It's now all of a sudden at the forefront of getting legalized. And even New York suddenly said, we're going to need to do this. We're going to approve this because they need to create new sources of revenue stream for the government. So I think things that benefit from regulatory environments or could be negative is really going to be a hot space going forward.
So maybe, do you guys sit down at the beginning of the pandemic and just say, okay, well, we're not going to do this. This is what we think is going to happen. Has that evolved over the past year? I mean, obviously, I think there's the clear trends that everybody, cybersecurity, et cetera. How does a fund look at it? When you may have gone into 2020, with, hey, this is what we're going to do. Obviously the world changed, and we're coming out a year later. I mean, is that something you guys sit down as partners and just say, hey, here are the trends we see coming out of it, and this is what we're going to go after? Is it still company specific? Hey, if a company comes across and it's in one of these verticals, we'll go after it? Or how do you guys think about that? I think it'd be interesting. Dave, how about you guys? How do y'all thematically think about the companies you go after?
Well, I think for COVID in particular, I think the hardest thing that we had to grapple with was discerning which companies that had unbelievable code-driven metrics were sustainably great in a post-COVID world. So if a company does remote video collaboration for a specific vertical, and they had been around for 5 or 6 years, and then only this year took off, the biggest question for us is, what does 2021, 2022 look like for that company? The only rule that we made around that was to be very, very deliberate about finding, defining the tailwinds behind this market and deciding what they look like in a work from work environment.
Jennifer, how about you guys?
I think for us, it's really a combination of both. I think, as probably many folks did at the beginning, we sort of hunkered down and focused on existing portfolio companies, right? Which ones we needed to focus on, whether it be to help positively or that could be adversely impacted, and then obviously followed trends as a result of that. With respect to Arsenal, we stay fairly loyal to the verticals that we focus on. That being said, we've shifted a little bit to include ed tech in that as a result of opportunities discovered through COVID. for the Florida Opportunity Fund, it's a little bit more broad, as are, right, sort of the industries of strategic importance. And so we can be a little bit more flexible in terms of, what we, chase there. But again, looking at the opportunities in the existing portfolio and learning, right, from the outcomes and how that has evolved over the past year has been critical to looking at, new deals and where we might, shift the portfolio matrix.
Ryan, anything to add?
Yeah, I think they nailed it. I mean, we took a 30-day pause last year. It's funny to think about it. It's basically a year ago, and we took a 30-day pause to kind of sort through it and clear our brains and try to figure out, like, all right, where, to the best of our abilities, where is this going? And lucky for us is it coincided with as we're starting our fund 2 in the fall. So we did have those discussions as to, like, where do we want to be, but it's where do we want to be for the next 10 years, And so we kind of figure out the 7 buckets that we felt were going to be really exciting spaces for the next 10 years, but also that we had a expertise and a large comfort in, and that's where we ended up primarily focusing. We're looking at a space deal, which is kind of outside our normal norms right now. There's a couple buckets, and we always leave a little bit of gray area, but we're very center focused on what we do best. For 90% of the portfolio.
One thing I would add that I guess is a little bit tangential, less about where we're investing, but how we're meeting companies. One of the decisions we had to make early on was whether we would back a company without ever meeting the founders in person. And we did end up doing that for the first time during COVID. I would say I think across the board, basically every fund that did a deal this year did something along that line. And I think especially for earlier stage funds that before wouldn't want to back a company that was too far away, just given the number of funds that they back, and 4 board meetings a year becomes 16 flights a year of commitment. I think in a world where everyone is happier with meeting electronically, I think from an earlier stage investor perspective, they have broadened their horizons specifically geographically, so that Florida-based seed and Series A companies can probably look a little bit further than they could before.
That's great. Great point, David. I actually was one of my next questions. Maybe Ryan, Jennifer, you can jump in on that. How has prospecting been different? Obviously, we're in a new world. There's less conferences, or at least less conferences where you're meeting in person, Florida Venture Forum being one of them, where, so you guys, I'm sure, would go and, see all the presenting companies, get to meet them in person. Now, I'm sure it's a bunch of Zoom calls, but are you targeting the companies? I mean, how's your business development arm changed throughout the pandemic, or has it?
I mean, it's changed a little bit, and I think, Dave was spot on in the comment, right? As at the beginning, it was certainly less likely, right? Diligence took a bit longer because you weren't able to get that face-to-face interaction with these folks. You could certainly cover the diligence and the business and deal terms, right, remotely, but getting a real feel for, the team and the people on a personal level presented its challenges. And so we would tend to spend, more time with folks, obviously having to do that, via Zoom or other mediums. And so we did, the same as Dave, close the deal, via that platform. We were about to close the second one, but we're fortunate that some of the travel was lifted, so we were able to at least meet that team, prior to closing. But, I think we've all gotten more comfortable with using that as a means to, quote unquote, get to know folks.
Yeah, for us, we also changed our process a little bit and started requiring that at least one partner spend some time on more of just a one-on-one personal call with the founder, get to know you session, far less about the business, but more just, is this the type of person we want to back? And, maybe coincidentally or not, but we also expanded our conference room during this time. So we blew out a bunch of the walls and made a massive conference room. So for founders that are willing, we've had several come in and we can meet kind of from a distance across the table and all spread out. And that's been actually pretty fun as well. But it's definitely a change. But I think for all of us in venture, most of us were on Zoom, 5 to 6 hours a day anyway before the pandemic. So now, 8 hours a day or 9, 10 hours a day is not really that much different.
Great. I think, Dave, you touched on this maybe a little while back. Metrics. How do you guys look at metrics? I mean, is it just purely ARR growth? Obviously, the two major ones you look at, but I'd love to hear how you guys think about metrics and whether that's changed during the pandemic. I think you had a great point on, hey, just because you went to 1 million to 5 million, that's great. But if it's all because of tailwinds, because of this year, and you really didn't have a sustainable business before, what does it look like going forward? How are you guys looking at metrics? Because I know all you guys are data driven. Just be interesting to see how you guys think about that.
Yeah, absolutely. From Radian's perspective, we're pretty much all SaaS. So, we follow probably a lot of the same metrics that Jennifer and Ryan would look at in a SaaS business. But we are very sensitive to retention, just because we think you can invest in growth by hiring salespeople to grow the product faster. But it's very hard and expensive to fix a retention problem, especially when it's typically product related more than anything. So, we're generally looking for companies that have 90% plus gross retention, which is, year over year, total revenue from the, prior periods, customers greater than 90%, and then net retention greater than 100%, kind of as a baseline. And both of those create, best in class types of companies at the enterprise level, and are even harder for SMB SaaS. But more than anything, we think of that as our guiding star. And then the other metric that I think we're also not unique in really focusing on is the idea of rule of 50, which is that if you add together your growth rate and your profit margin, you're greater than 50%. So it's fine to be burning money, but you have to be growing, or it's fine to be not growing super fast, but you have to be profitable in those cases. And we think about companies that fall outside of that range, or below that range, as kind of being either in more of an R&D type of, rebuilding year mindset, or being in a dead zone where they need to try to find their way out of it really quickly.
Used to be rule of 40. Did y'all add 10 to it during the pandemic?
Yeah, there's been some metrics inflation over the last few months.
Jennifer or Ryan, I assume y'all are probably pretty similar, but Ryan, you're a little bit earlier. Maybe you can, maybe metrics aren't as important, are they? Would love to.
Yeah, they are. I think it's still company specific sometimes, or sector specific. Churn's obviously a big one. TAM, I think, is probably the most overrated statistic in venture, at least in my opinion. I want to see that the market's big enough that so often the founders get caught up in we've got a $50 billion or $300 billion TAM. And it's like, all right, I don't really care, because we're never going to see that. I just want to see more of the thought process is what I look at more than anything else, is how do you get it? And, I think to Dave's point, it's the consistency of growth. It's probably the most frustrating thing, how many founders don't have financial statements. And granted, it's early stage, but the headache you have to go through to get month over month, going through a pandemic, a lot of times you have to be able to see what happened to their business during that time, and are they coming back? And the founders that have that together, it just gives you so much more confidence from the start, not pulling teeth. So that's some of the stuff. But gross margin, yeah, I agree that's something we're looking at. We don't have the rule hard and fast, but we want to just see that it can get there.
Jennifer, anything to add from your point?
Not really. I mean, as you would expect, ours are going to be, very similar to those that were mentioned by Dave and Ryan.
So what are some challenges? So obviously finding companies, right? We've talked about that, investing in companies, what are you looking for? Now you've invested, right? I think one of you mentioned that certainly the first thing you did during the pandemic was look at your portfolio, right? And make sure that, I think most funds across the company or across the country did the same, did triage, made sure which other portfolio companies were healthy, which one could use help. What are the biggest challenges there? I'm sure you're used to traveling in person to see your board or your companies, going to board meetings. I mean, has anything changed from how you guys view your existing portfolio companies throughout the pandemic?
I think there's probably, more frequent communication. I mean, we typically, for some of our, early stage investments, start with, monthly board meetings in any event. But even for the later stage deals now, it's just, being, having more touch points with, not just the CEO, more members of the management team, and just, finding, right, how can we be helpful? What are the challenges? Where do you need assistance? And how can we, dig in and be another resource for you? A lot of these companies are, constrained on some of those fronts and should and can leverage, board members and investors for support.
Yeah, I agree. I hadn't really thought about this until just now when Jennifer said it, but in a volatile time like that, like this past year, we've had the pleasure of spending a lot more time with our companies than we had in years past, because every one of them was affected one way or another. Some of them brilliantly positively, and others of them faced some headwinds, and it created a good opportunity for us to get closer.
That's great.
Yeah, and I think it definitely, it offered us a glimpse in the separation of who are really strong founders and who aren't, who can kind of handle the day-to-day stresses and who can't. Some of them, we haven't heard from as much, and I don't think that's a bad thing, because there's been such opportunity. They're just head down grinding all day long, and there's such a big opportunity. They're just grabbing it and going, and they don't have time for calls, meetings, anything else. They're still checking in. Others, there's kind of the second category that they came to us, they've spent some time, we're happy to reach out and spend time helping sort through some of these things. And I think a lot of those have been successful. And I tell founders, like, the worst mistake I ever did was in 2007 and 8, when I was running business by myself, and it got crazy in the middle of the crash. And I didn't go to other people, to talk through it. And it would have been a lot easier to step out and get some other perspectives, but I was so caught up in the tornado myself, couldn't see through it. And the founders that have taken that time to kind of just bounce problems off of others, even if it's other founders, if not your investors, I think have probably succeeded and done the best. The ones that, haven't basically fared well during a period of isolation, and you've seen some of them potentially struggle.
Right, you bring up a good point there, and I think that's another thing I wanted to touch on was, obviously the company, the metrics, et cetera, but the founder, right, the team. I think that's the thing I probably hear the most from venture investors, right, especially since you guys are taking a chance on a business that's not mature, right, that's growing and going through a lot. What do you guys look for in a founder, a founding team, just generally? I've heard some funds say, hey, we want someone who's done it before, experienced founder who's kind of been there, done that. Others, just has to have a technical lead. I'm just trying to think about how you guys think about founders and founding teams for your investments. And maybe there's no one rule of thumb, but what you see that you guys like or what you look for.
I think what.
Yeah, go ahead,
Sorry.
Jennifer, go ahead.
Jennifer, go ahead.
No, I was going to say, I think what, you said was important about, right, obviously all of us would love to have all of our CEOs be repeat, successful CEOs. But I think in addition to that is having someone that is, truly a leader and, is not, wants to hire, right, people as alongside him that are just as, if not smarter, right, in their respective, whether that's your CTO, your sales and marketing team, et cetera. So, we really want to see not just the CEO, we want to see a strong, C-level team, that's going to be able to scale and take the company through a successful exit. And I would think also, one that is flexible and right, maybe at the beginning that in expectations that's not going to be the CEO that exits the company. So someone that can recognize when and if it's their time to, right, bring someone else in that position.
Yeah, I couldn't agree more with Jennifer's first point on the surrounding team being a reflection of the CEO. That was exactly the point that I wanted to make.
Yeah, I agree as well. There's a perseverance factor that and kind of a tenacity that you're looking for, and you're trying to pull that out from all sorts of different data points. It's kind of hard, but there's a lot of conversations that happen prior to funding, you're kind of piecing all those things together with little tiny tests here and there, questions, and putting the puzzle together. And for us, we've got 4 partners and 5 partners on the investment committee, and kind of they each look at it a little bit different. Interestingly, last year there was a study, I think it was last year, Andreessen put out, about statistically what results in the best outcomes for startups. And some of the things I think a lot of people previously thought weren't really statistically significant to us. And so that caused a lot of debate, but to us, having some sort of experience in the space and being able to leverage that experience maybe into opportunity is one that we really prefer. A founder who's either had success or even failure and learned from that failure is interesting for us to kind of dive into. And then, just the team and advisors around that obviously is a big key. Looking at that, so there's a lot of different things that we look at, and also skin in the game. The founders who, this is critical to them. This is all in. The funniest thing, I'll tell you guys a funny story real quick, is one of the founders I met with recently, I went to lunch with him and talked with him, trying to get an idea of who this guy is. He moved here from another country, and he's talking to me about how head down he is into this company. And he's telling me about his girlfriend, and she's a supermodel over in Italy. I'm like, okay, well, how's this going to work? I don't want to invest in you, and then, you move to Italy next month after we close the round. And he said, look, I told her that no matter what, this is my priority. And it was an interesting story, but it kind of took on a life of its own as he got engaged recently, and it was all over the Italian press and social media. And we're like, wow, this is really true, and he really is staying here. It was kind of a funny story, but you're looking for the people that, I don't know, you want them to be grounded and have kind of a life that they have some other activity. That was actually one of the biggest things out of the Andreessen study, was what is their other passion? And you try to dig into that. Do they have something? But you want the people that are all in as well at the same time.
Great. I appreciate that. As you all can expect, whenever you ask for questions, everybody lines up, and we won't get a lot. So maybe we'll do one more question for you guys. If anybody has any questions, we'll do it. If not, we'll cut a little bit early. So, if we were sitting in here February 2020, no one would have saw, what was coming. So it's just fascinating from this time to, kind of March 15th, how much the world changed. But now sitting here, whether it's Florida, the venture industry as a whole, tell us, kind of what you see the next year, 18 months looking like. I think Florida has a lot of momentum. I think we're all excited about it. I think the venture industry, hasn't been slowing down, but also, we haven't seen a break in valuations in years. I don't know if you guys see that on the horizon, but what do you guys, I know you can't predict the future, and certainly if we were all sitting here last year making predictions, it would have been pretty laughable. But would love to hear what you guys kind of see for the industry in Florida specifically in the coming 12 to 18 months.
I'll jump in. I think on the venture side of the world more broadly, venture funds can have a 10, 15, 20-year life cycle. And over the last couple of years, there have been record fundraisings across all stages, from seed up through late stage growth and private equity. And those commitments don't go anywhere in a market correction. So I think thankfully for the entrepreneurship world, I think there will be a relatively founder-friendly funding environment for years to come. And I do believe that more and more funds like us will have to spend time outside of their backyards and into interesting areas like Florida.
Yeah, I think that, the good news is, right, there's a robust amount of capital for deployment into venture, which in both funds and then subsequently into companies. And so, I think healthcare, education, all of those, cloud tech-enabled services for remote we'll continue to garner a sizable portion of that. But, hopefully towards the end of the year and going into 2022, when, even if it is a hybrid model, we'll start to be able to, have in-person, connectivity and interaction again.
Great.
Yeah, I think, for the foreseeable future, it looks good. Although, when we're raising our fund, we take the approach, we got to raise it as quick as possible because you never know what's going to pop up around the corner and cause a pause in the capital markets. Things have been good for so long. A lot of people have forgotten what it was like a decade ago. And, I tell founders the same thing. Like, if you can take a good valuation in capital now, even maybe if it's a bridge, like, you take it, you don't wait and find out 6 months from now the capital markets are locked up. But to their point, so much money is on the sidelines in some of these larger funds. Like, there's going to be capital around for the best companies for a long time.
It's funny you bring that up. A decade ago, down rounds, something I was expecting coming out of the pandemic, maybe to see more down rounds, bridge rounds, et cetera. And it just hasn't materialized. So I think that's something that people haven't seen, a lot of, on a consistent basis in a decade. So, and I think you're probably right. We're not going to see it anytime here in the near future, but that's great advice.
Yeah,
well,
interest rates are what need to be. That's the wild card. You got to watch interest rates. If interest rates spike up for some reason, it changes the whole asset class theory. But I think venture is here to stay. But if the interest rate environment stays like it is, it's kind of the green light for a long time.
That's great. Well, coming up on the end of the hour here, and it doesn't look like we have any questions. So what I think we'll go ahead and just say goodbye to everybody. But first of all, I want to thank our panelists, Ryan, Dave, Jennifer. Thank you for finally. Sorry for the technical difficulties, but you did a great job from the phone. Glad you joined, or else Ryan and Dave were going to have to really carry the load here for a while. But they did great. We missed Drew this time. But if you want to see more content like this, there are going to be a lot more panels. Discussions next week at Florida Venture Forum Conference. So join us for that. But otherwise, everybody have a great rest of the day and weekend. And we'll hopefully see you all in person soon. And thank you for joining us today.